Welcome to The Explainer. The stock market is hitting all-time highs, and on the surface, that sounds fantastic. But if you dig just a little bit deeper, the data reveals a pretty startling truth. This record-breaking rally might just be built on a foundation of sand, and one gust of wind could bring the whole thing down. Let's break down what's really going on. So, on the face of it, everything looks great. On April 9th, 2026, the S&P 500 closed out another winning day, climbing just over 0.5%. In fact, this was the 7th straight day of gains, pushing the market deep into record territory. From the outside, you think it's absolutely unstoppable. But is it really? Because when you start to peel back the layers here, a very different, and frankly, a much more worrying picture starts to emerge. Okay, let's dive into this. So, the first big clue that something isn't quite right, it shows up when we stop looking at the market as one single thing, and instead we compare the giants to, well, everyone else. While the big headline-grabbing indexes like the S&P 500 and the tech-heavy NASDAQ were surging, the Russell 2000 index, which is our best gauge for smaller companies, was actually falling. Now, that is a major red flag. It tells us that the strength you see in the market isn't widespread at all. It's isolated to a very, very small group of companies. And this number right here, this just illustrates the problem perfectly. On a day the market supposedly hit a record high, more than half of all stocks, 54.5% to be exact, actually ended the day lower. I mean, think about that for a second. The index is up, but most of the stocks that make up the index are down. How is that even possible? Well, this is a classic textbook sign of extremely poor market breadth. You see, a healthy, sustainable rally is like a rising tide that lifts all boats. But what we're seeing here is the exact opposite. It's an unhealthy rally where just a few mega yachts are creating a big enough wake to make it look like the tide is rising, while most of the smaller boats are getting swamped. So the big question is, who's holding it all up? Well, the answer probably won't surprise you too much. It all comes down to an intense and pretty much historically unprecedented concentration of power in just a few mega corporations, right at the heart of the AI boom. And what's really wild about this slide is just how extreme this has gotten. A mere 10 companies, just 10, now make up an incredible 41% of the entire S&P 500's value. To put that into perspective, this level of concentration is even higher than it was at the peak of the dot-com bubble. That means the performance of 490 other companies is almost completely overshadowed by what happens to just 10. And even inside the tech world itself, there's this huge divide. We're seeing a massive rotation of money out of software as a service companies, the businesses that sell subscriptions, and into the handful of firms that are building the physical hardware, the chips, the servers, the data centers that actually power the AI revolution. So the crucial point here is that this rally isn't a sign of a strong, booming economy. Not at all. It's a technical distortion caused by a massive amount of capital chasing a very, very small number of AI infrastructure names. But underneath this concentrated rally, there's an even bigger, more systemic risk lurking in the plumbing of the financial system. This concentration is one huge crack in the foundation. But there's another, much larger one that could bring the whole thing down. Because while the market is mesmerized by AI, the financial system's main safety net has all but disappeared. To get this, we need to quickly look at something called the Reverse Repo Facility, or RRP. Now, it sounds complicated, but the simplest way to think of it is as the banking system's emergency cash drawer. When banks have too much cash, they can park it at the Fed overnight in the RRP. It acts as a buffer, and it provides stability to the entire system. It's a sign of a healthy, cash-rich system. Well, that buffer, which not too long ago held over $2 trillion, now has just $402 million left. That is a staggering drop. In the grand scheme of the multi-trillion-dollar U.S. financial system, $402 million is, well, it's effectively zero. The cash drawer is empty, the safety net is gone. This creates a really dangerous sequence of events. First, the buffer's gone. Second, we have the massive cash withdrawal for tax day on April 15th coming up, which is going to suck billions out of the banking system. With no buffer to absorb that shock, the risk of a severe liquidity crunch, a sudden, unexpected shortage of cash, is dangerously high. So when you put all of these pieces together, the poor market breadth, the extreme concentration, the drained liquidity, the market's winning streak looks less like a sign of strength and much more like a fragile, precarious balancing act. The source report that we're drawing from calls this a state of fragile equilibrium. It's this illusion of strength built on the very narrow shoulders of a few AI giants, while the foundation of the financial system has basically been drained of all its support.
As the report so perfectly puts it, the market is packed with potential energy. Think of it like a coiled spring. This extreme concentration and these high valuations are the spring being compressed more and more. All it needs is a catalyst, just a tiny spark to release all of that stored energy at once.
And that spark could arrive as soon as tomorrow, with the release of the March Consumer Price Index. The forecast is for inflation to remain stubbornly high. If that number comes in hot, it could be the catalyst that turns all this market's potential energy into very sudden, very real kinetic energy. That is the one number to watch.